Everyone thinks earning 30% annually in the stock market requires crazy risks or complex daily trading. But investment legend Warren Buffett proved to the world that historical wealth is built on simple, logical principles. From a business psychology perspective, Buffett's genius doesn't lie in mathematical brilliance, but in his strict psychological immunity against greed and collective panic. In this video, we'll dive deep into the behavioral psychology behind the 5 rules Warren Buffett relies on. We'll show you how to reprogram your investment mind to stop chasing quick tips and start building your real wealth based on behavioral science. Rule number 1, Buffett never invests in what he doesn't understand, avoiding the illusion of knowledge. Rule number 2, he invests for the long term, immune to market noise and daily fluctuations. Rule number 3, he buys when others are fearful and sells when others are greedy, mastering emotional contrarianism. Rule number 4, he focuses on business value, not stock price movements, seeing companies, not ticker symbols. Rule number 5, he maintains a margin of safety, buying quality assets below their intrinsic value. These 5 rules aren't just investment strategies. They're a complete psychological framework for conquering market fear and building lasting wealth. Warren Buffett's first 2 rules reveal the hidden psychology behind stock market success. Rule number 1, a stock is not just a number on a screen. Warren Buffett explains that buying a share means owning a real piece of an actual operating company, not just a piece of paper for speculation. Psychologically, this fights the abstraction bias, where a beginner investor forgets the company's real value and focuses only on the screen's movement. This leads to making emotional and wrong decisions, driven by panic. Rule number 2, completely ignore daily media noise. Warren Buffett advises complete detachment from daily news designed to trigger panic. Psychologically, media outlets exploit humans' innate fear instinct to increase viewership. They weaponize loss aversion, the psychological bias where humans fear losses more than they value gains. Isolating yourself from this noise protects your prefrontal cortex from making impulsive selling decisions when markets drop. This mental discipline separates long-term wealth builders from emotional traders who react to every headline. Warren Buffett's psychology teaches us that true investing success comes from owning businesses, not trading noise. This is Warren Buffett, the man who turned patience into billions. Today, we uncover rules 3 and 4, the psychology of staying in your circle of competence, and the exponential power of time. Rule 3, stay inside your circle of competence. Warren insists on investing only in companies whose business models he fully understands. He refuses to chase complex technology trends he doesn't understand. This is a battle against overconfidence bias. Psychologically, overconfidence bias makes investors believe they understand everything, leading them straight into the trap of loss. Warren avoids this trap by simply saying, "I don't know," and walking away from what he doesn't understand. Rule 4, the power of time and compound growth. Warren sees time as the greatest friend of great businesses. Human nature hates delayed gratification. We crave instant emotional rewards and quick profits. But training your brain to understand exponential growth over years is the psychological key that keeps you from exiting the market too early. Imagine investing $10,000 at age 20. With compound growth at 10% annually, by age 60, it becomes $450,000. But most people panic and sell during market dips, sabotaging their own exponential future. Warren's genius lies in his ability to wait, to let time do the heavy lifting while others chase noise. Circle of competence plus compound time equals unstoppable wealth. Warren Buffett's 5th rule, margin of safety and buying during terror. This rule is built on Buffett's famous principle: be fearful when others are greedy and be greedy when others are fearful. Buffett only buys stocks when they are priced far below their true intrinsic value due to market fear. When the stock market collapses, the fear center in the masses' brains activates from a consumer neuroscience perspective. This fear drives them to sell their assets cheaply in panic. Here comes the disciplined investor who completely separates his emotions. He exploits this collective ignorance and panic for his own benefit with cold blood. He hunts historic deals during market catastrophes. While everyone runs away in terror, the disciplined investor sees opportunity. This is the psychology of margin of safety, buying assets when they are on sale due to irrational fear. Market panic is not a threat to the wise investor. It is his greatest weapon. When the crowd loses its mind, the disciplined mind wins the game. We conclude with Warren Buffett's complete psychological blueprint, a practical action plan to transform these 5 rules into real results in your life. Turning these principles into reality doesn't require billions in capital. It requires a mind trained in resilience and self-control. Warren Buffett proves to us that the stock market is simply a mechanism, a tool that transfers money from the impatient person to the patient person. We send a powerful message to you. Your investment success begins the moment you stop thinking like a gambler, and you begin thinking like a disciplined business owner, psychologically prepared to commit to the long-term plan. No matter how stormy the market turbulence becomes, you stay anchored to your strategy with unshakable conviction. Rule 1. Think like an owner, not a ticker watcher. You're buying businesses, not lottery tickets. Rule 2. Ignore the media noise. Financial headlines are designed to trigger fear and greed, not inform rational decisions. Rule 3. Stay within your circle of competence. Mastery in one domain beats mediocrity in 10. Rule 4. Practice delayed gratification. Compound growth requires patience, not constant action. Rule 5. Demand a margin of safety. Buy quality assets when fear drives prices below intrinsic value. This is your psychological operating system, the mental framework that separates wealth builders from market casualties. Follow us for more.